Investors Chronicle.
Welcome everyone to the IC Interviews podcast. With the year drawing to a close, it's time for our annual discussion with IC Associate Editor Simon Thompson. Simon's been a vital part of the Investors Chronicle for the past 27 years, and for much of that time, he's focused on small caps, including his yearly bargain shares selection. Today, we'll be discussing the year ahead, what 2026 might hold for UK smaller companies and for the market in general. Simon, great to have you here again. Welcome to the show.
It's great to be here. I think we're going to have a very interesting year ahead of us.
Indeed. May we live in interesting times. We always seem to nowadays. We're recording this on the first day of December. So for one thing, the budget has finally been and gone. But when I was considering the other day what we might talk about, it did strike me that many of the outstanding questions facing the UK market are the same as they were last year. And the context is in some ways the same too. That backdrop being fairly muted, albeit not terrible, economic growth, another good year for UK shares, although small caps have lagged again. So with this in mind and with politics potentially out the way for now, what's your view on how UK equities are positioned for 2026? Are valuations looking attractive overall, and what's your general take?
I think they are well positioned. The first thing to remember is that UK investors have actually pulled about £26 billion from London-listed equities in 2025. That's measured by outflows from funds investing in the UK. Despite that, the FTSE 100 is on course for its best year since the global financial crisis. The FTSE 100 is on a total return basis up 23% this year. The S&P 500, as of the last day of November, is up 16.5%. So the FTSE 100 has actually outstripped the S&P 500 for the first time in years. And despite those fund outflows from UK investors, the other side of the equation is that foreign investors, there's been about £15 billion of inflows into funds, and that's because they're looking to diversify their exposure beyond the US. And the London market is seen as relatively cheap, which it is, which I'll go on to explain why. But within the returns of that we've seen this year, the FTSE 100 has led all other segments of markets, trailblazing. The FTSE 250 is only up 7.3% in the first 11 months. That's total return index. Small cap 7.9%, and the AIM share 9.1%. So it's a massive outperformance. And the reason for that is that the FTSE 100 is the banking sector, and gains from mining and defence companies have been key drivers this year. But more importantly, is looking ahead for prospects for 2026. And if you look at the FTSE All Share Index, which is the FTSE 100, FTSE 250, and the FTSE Small Cap Index, well, according to Investec, that trades on about 13.5 times earnings. Well, that represents a discount of more than 40% to the S&P 500, and a 24% discount on an equal weighted basis. And that suggests to be scope for further outperformance of the S&P 500 plus absolute performance as well. To give you some idea about the disparity in valuations, Yardeni Research estimates that the S&P 500 trades on a 12-month forward PE ratio of 12.4, and the Magnificent Seven stocks, they're a forward PE ratio of 29. So there's a huge difference in valuations between the two markets. That's also highlighted with the FTSE All Share Index. It's got a dividend yield of 3.2%. But what isn't most investors, something they look at is the free cash flow yield. Well, the FTSE All Share Index, that's 6.3%. The S&P 500, 2.65%. So it's more than twice as high. And that to me suggests scope for outperformance. The other thing worth noting for the year ahead is that although small caps and micro cap stocks have underperformed this year, in previous cycles, the large caps have often led the small caps. So then there's scope for catch up. The one major issue is AIM's woes. The strong constituents are gradually moving to the main market, and we've seen that throughout this year. You've got regulatory constraints between the two markets has actually narrowed, so that undermines some of the attractions of the junior market. 12 months ago, last budget, our Chancellor slashed the tax breaks for AIM companies. That hasn't changed. You've had a huge number of delistings, takeovers are rife, and companies aren't really coming onto the market through IPOs. There's been a handful of those this year.
Mm.
So those are the issues that AIM faces. Having said all of that, I don't have a problem finding value in the small and micro cap space. Before I came on this interview, I looked at the performance of the last months of alpha small cap reports that I produced for Investors Chronicle. I've produced 12 of those. The average return has been 46%, 11 winners, one loser. The average return for the AIM index over the same period, if you put the same amount of capital in each report, was only 3.5%. So what I'm saying is that stock pickers can actually outperform the AIM market, outperform the main market. And the reason for that is I'm basically screening a company on very low earnings multiples. Most of the companies I recommended are on cash adjusted PE ratios of 10 or less, modest price to book value ratios as well. I don't have a problem finding those. So it wouldn't take much in the way of mean reversion for AIM and small caps to start to perform better than they have done this year. But the major thing is that central banks, for the direction of equity markets, are going to play a major role in whether the bull market continues. And that depends on the economic data that's going to come out on both sides of the Atlantic.
Yeah, let's talk about that economic backdrop then. We'll come back to AIM, of course, and valuations in a little bit. But in the UK, how do you see that backdrop, that context? Do you think it's supportive? I mean, rates have come down only gradually, similar case to last year again. Businesses have faced pressures from last year's budget measures, as you mentioned, such as employment costs. GDP is ticking up, but only very slowly. How do you see that whole fiscal and monetary policy picture?
I've got an interesting take on this. I mean, there's no doubt businesses are under pressure, and especially those with little pricing power to mitigate the impact of higher cost pressures. And I expect investment for corporates to remain subdued. I mean, you'd expect that given the pressures companies are under. And I expect companies to look to derive higher productivities from existing employees and AI initiatives in such an environment. That's already happening. The number of new job openings is falling in the UK as companies hold back on replacing employees. But bizarrely, the overly pessimistic narrative from the UK government and the fiscal tightening that we've seen over the last 12 months could actually be a silver lining for UK equities. And that's because it increases the likelihood of sharper falls in UK interest rates. My take is that if wage growth moderates in line with falling job vacancies, consumer demand remains relatively constrained, it should actually enable the Bank of England to start cutting interest rates to drive down short-term borrowing costs if, and it's big if, they can look past sticky inflation. Why is that important? Well, most companies, especially in my small cap and micro cap space, borrow against either SONIA, so a margin above SONIA, or a margin above Bank of England base rates. So be putting more cash back into their pockets if the Bank of England starts cutting short-term interest rates. Also, what's happening in the US and the US economy will have a major implication on the direction of UK equities, and politically too. If Donald Trump gets his way and he appoints Kevin Hassett, he's the director of the National Economic Council. But if he appoints Hassett as chair of the Federal Board of Governors, which the short odds in that's actually happening now, and if Lisa Cook, who's another member of the Federal Open Market Committee, the rate setting committee of the Federal Reserve, if she's removed by the Supreme Court, which is what Donald Trump wants, then it opens up the real possibility that US interest rates will fall sharply next year in response to a weak labour market. And that's because the FOMC will be stacked full with pro-Trump members. And why is that important? Directional moves in the US and UK rates are very highly correlated. The other point worth remembering or pointing out is that inflation in the US is sticky too. So we could have a situation in both the UK and the US, the economies are slowing, interest rates are being cut, and real interest rates move towards zero. Now, that's bad news for bond investors. It's brilliant news for the precious metal space, which I'll come on to later. And it's highly supportive of earnings multiple expansion for equities and the bull run continuing. And that's basically my base case scenario for this year. The other, you've got a few things that you've got to bear, take into consideration. One is risks. If we see a spike in bond yields in Japan, as we have done recently, in response to the expansion there, it could lead to heightened equity market volatility. And that's basically because it's a reversal of the carry trade where people borrow in yen and then invest in higher yielding, more speculative assets overseas. And as soon as interest rates start spiking in Japan, those carry trades start to unwind. And we've seen that again and again over the years happen. Another risk, obviously, is recession risk in both the UK and US. My base case scenario is that we'll have a period of stagflation rather than recession. And there is one positive that could come out of recent developments, and that would be an end to the conflict in Ukraine, which would be positive for equities as it would lead to lower energy prices, easing cost pressures on companies and consumers, and actually give a boost to economic growth.
Indeed. Well, there's a lot to take in there, and there's a lot to consider for next year, clearly, as ever. But I wanted to, before we move on, I wanted to talk about the budget itself, which has just gone, as we said, as we record. It took place a few days ago. So we're still very much in the initial reaction stage. But I wanted to see whether you think there are any measures there that are likely to move the dial either way for the companies you cover. Last year, as we said, there were the hikes to national insurance rates for employers. This year, we've had a minimum wage increase again. Might be an obvious thing for companies, but I wondered if there's other things you've found in there that might be of note for the next 12 months.
It's generally positive. There's been no real major hits for companies I follow that are reliant on government funding for their end markets. Shares in some companies sold off ahead of the budget and the uncertainty. So there's scope now for bounce back rallies after the dust settles, given that the budget could have been far, far worse than it actually was. I've picked out a few of the companies on my watch list that I can see deeper value now than, say, 4 weeks or 8 weeks ago. Two of them are in the space of telematics and diagnostics to improve fleet efficiency for UK transport, which is all basically government funded. And one company is Synetics, another is Journeo. Well, Synetics is trading on a PE ratio of 10. Net cash equates to a sixth of its market cap, and its trading prospects haven't changed at all in the last couple of months. They haven't deteriorated, they're actually quite good. But it's got that low rating, which is the uncertainty that was created by the budget. Journeo is another. It operates in identically the same space, trades on a cash-adjusted PE ratio of 13. Time Finance, that's a SME lender. Well, it should continue to do well, as 90% of all new lending is hard assets, and there's a lack of competition from high street lenders. There was absolutely nothing in the budget to incentivize legacy lenders to ramp up lending to SMEs, so small businesses and medium-sized enterprises. Time Finance shares have come off. They're trading on about 10% discount to tangible net asset value and a PE ratio of 7. I said at the start of the podcast, I don't have a problem fighting value. Well, PE ratio of 7, the year to May, that's what the forward rating is, even though earnings per share should grow 10% in that period. One company where there is uncertainty is Jersey Oil and Gas. It's a North Sea exploration company with a stake in the 70 million barrel Buchan fields in the North Sea. What affects that company is the changes to the current energy profits levy regime, which effectively will remain in place until March 2030. After March 2030, a new regime comes into effect whereby companies will pay 40% on their profits thereafter, and on top of that, an additional 35% levy, assuming the oil price is above $90 a barrel and the gas price is above 90 pence a therm. Personally, I think it's a sensible replacement for the previous regime. But what isn't positive is that we've got to wait the best part of 4.5 years for it to actually kick in. And the argument for timing the Bucking developments, and Jersey's got partners, Neo Energy and Serica Energy, two very large companies operating in that area. There is actually a case, both for Jersey and for other companies, to basically time their projects so they actually come on stream after the current regime ends in March 2030. We'll have to wait and see what the partners for Jersey decide to do, but the shares trade on an 80% discount to Zeus Capital Risk's net asset value of 543 pence a share. But until we've got more clarity in the situation, I can just see them trading sideways. So it's a mixed bag, but generally speaking, the companies I follow, it could have been a heck of a lot worse, is the bottom line.
Yeah, that does seem to be the initial thinking from a lot of people. And that brings us on to perhaps two catalysts certainly for small caps to do better next year, one of which may be the fact that pre-budget uncertainty, which has been with us for a long time, given the long run up to the budget, has now cleared. It could be a type of clearing event. Before we get into other specifics or near-term macroeconomic drivers, I wanted to ask, though, about measures to boost the attractiveness of UK markets in general, because there's been a lot of talk here in acknowledgement of the fact that certainly that IPOs have been struggling, that new listings, companies in the UK have been taken over or taken private or merged with bigger overseas entities. We've seen in the budget things like a cut to the cash ISA allowance. We've seen the Mansion House agreement regarding pension funds investing in unlisted assets, which also includes the AIM market. The Leeds reforms, for example, a lot of talk. Do you think any of those things could themselves have an impact in the near to medium term on the health of the UK market?
Well, I think we've got to dial back 4 years. Since September 2021, over 25% of UK smaller companies' funds have been withdrawn from the UK market as investors recycle the capital to other higher growth markets. That's the decision of those investors. And although there is value on offer, which I've noted a few companies so far, especially at the smaller end of the market, and the AIM index trades in a single-digit enterprise valuation to cash profits multiple, you can't actually force investors to invest by lowering cash ISA limits. Those people using cash ISAs, in my opinion, are generally not choosing cash as an investment, but more for short-term goals like saving for a house deposit, what's actually benefiting from tax-free interest. And the money displaced from those cash ISAs will probably just end up in taxable savings accounts, not the stock market. That said, if only a small amount of the 8,000 or the £20,000 ISA limit, annual ISA limit, is put into equities, then it will be positive, but it's not enough to move the dial. In terms of the Mansion House reforms, even if pension funds were to increase the weightings in unlisted assets as a default option, investors will still be able to switch out of those default options and invest the funds in other assets. I am really, really skeptical about how these measures will create an environment for improved investor sentiment and actually attract material fund flows into the UK market, which is actually heading for a 20-year low in IPOs. Basically, making something mandatory is never a good thing. You give people a choice and they will make that choice, hence why 25% of UK smaller company funds withdrew from the market in the last 4 years. I just don't think there was enough there to actually move the dial at all. That's just my opinion, but I don't think there is.
Indeed, I think that's a very, very fair assessment of what we've seen so far. That leads us on then in turn to what might move the dial for the UK. What do we think could be the catalysts for unlocking some of this value? We've spoken about the value on offer in some cases, very low digit PE ratios, for example. The budget's out the way. UK shares still look cheap. We thought this to some extent last year, though, and while the large cap index, as you said, has had a very good year, smaller companies, while doing okay, in some, have not had a fantastic year again relative to other risk assets. So do we see something coming up that could change that? I know you spoke about the Bank of England base rate cuts. That could be one thing, for example. What's your thought?
Well, if the outperformance of US equities versus the rest of the world is over, and given the massive challenge to flows that it's driven, it's potentially a watershed moment. We've seen funds flow into Europe as investors diversify portfolios, and that's likely to continue. And as noted, foreign funds are flowing into the UK, even if UK investing pulling them out from UK funds. Ultimately, it goes back to valuation. UK equities are undervalued relatively, so M&A activity is likely to continue being a major theme this year into 2026, especially in a falling interest rate environment that will facilitate debt-funded deals at a lower hurdle rate. The interest rates by the US Federal Reserve, that's really important. It could lead to a lower US dollar. I mean, the dollar has been in decline all through 2025. And if you've got falling US interest rates and falling real interest rates, well, that's a boom for gold, silver, and other precious metals. Why is that important? Well, on AIM, the mining sector, junior mining companies, account for 17% weighting in the index. That's the second largest sector. I'm actually playing that theme through exposure to a fund which is not listed on AIM called Baker Steel Resources. A third of its portfolio is in mining companies, effectively making it a leverage play in higher precious metal prices. The other area that I'd be looking at is the AIM technology sector. That's a 9% weighting. M&A activity for software companies and tech companies is not going to change. It's still going to happen because of the wide valuation disparity between UK equity ratings and those overseas. I mean, for example, I put offer readers into a small cap company called Audioboom. It does podcasts both in US and the UK. That was back in July. Share price has doubled, but that's not the major point. The point is it's now in play. It's in a bid situation. And analysts at Cavendish have valued the shares at 1,300 pence, which is double the current share price. And that's after the share price has doubled. At the target price, Audioboom's enterprise valuation would equate to about 43 times its cash profits, which would be in line with international audio tech peers. The point is that its forward rating at the moment is half international peers. And when you've got such a disparity between UK valuations and those in other markets, there's always an incentive for M&A activity. So I think M&A will absolutely boom in 2026 as these valuation anomalies are basically arbitraged away through M&A.
That, in turn, I mean, we're flowing quite nicely here. I think that leads us on to the discussion about the AIM market in general and the size of it, the shape of it. We've seen a lot of M&A already. We've seen main market moves, as we've alluded to, delistings in some case. How concerning is that for you? You're still clearly finding opportunity, as you mentioned, with the reports you're doing for the IC. Bargain shares, again, very much outperforming this year, the AIM market, that is. What do you see when you look at the market as a whole? You see these companies moving away. You think about the number of companies on AIM now versus 10, even 5 years ago is much lower. We've seen a slight resurgence in IPO activity higher up the scale, but not really so much on AIM, and even higher up the scale is baby steps really at the moment. Do you see that as a concern? Are you finding yourself looking at other parts of the market more often now? Do you still see it fully as an opportunity in that not many people are looking here, so that creates the kind of opportunities, the kinds of valuations which we've been talking about so far?
I am concerned, and to explain why, there are only 552 companies now listed in the FTSE AIM All Share Index. They've got a cumulative market cap of £41 billion at the end of November. There's another 78 companies not included in the index. So basically, there's a total of 630 companies listed on AIM. The AIM 100 has got a market cap of almost 32 billion. out of that 41 billion I just quoted. So, over 75%. So it means the other 452 companies in the AIM All Share Index have got a market cap of less than 10 billion, or just over 200 million pounds each. Size of the market, go back 10 years, there were over 1,000 companies listed on AIM. So it's a much smaller market with fewer pickings. At the same time, the number of new listings, as you said, has diminished. Only 16 this year, raising only 141 million pounds. And also this year, at the same time, 65 companies by the end of September had cancelled their listing. So 16 have come into the market and 65 have left. So it's just shrinking. Moreover, if you actually drill down the market caps of those companies, 146 of the 630 companies, so more than a fifth, have a market cap below 10 million pounds. So liquidity becomes an issue for actually trading those shares. So for my hunting ground, effectively, there's only 242 companies with a market cap between 10 and 100 million pounds. That's the area of the market I'm basically looking at in AIM. And that means there's far less choice and offer. That's concerning for me. So I've had to look at other areas to get around this issue. And one of those areas is looking at closed-end funds. And you mentioned bargain shares. So one of the companies in the bargain shares this year was Agronomics, alternative protein company that has a focus on cellular agriculture and cultivated meats. When I put the readers into the company back in February, the net asset value was over 14 pence a share, and the share price was 4 pence, and it had cash in the bank. Such was the, ridiculous valuation at the time. It's the top performer in the portfolio this year. The share price is up 70%, but the discount to NAV is still more than 50% because NAV has actually increased. So I still see value there. Another one, which is another bargain share, is RTW Biotech Opportunities. Basically, it was a larger fund which merged with Arix Bioscience. That was a member of my 2023 bargain shares. And what I like about this, and I can't get this from the AIM markets, it's a play in the acceleration of M&A activity by big pharma of late-stage assets and the willingness of large pharma companies to secure future revenue ahead of pivotal data. Why is that important? Well, with patents expirations approaching, more and more large pharma companies are becoming increasingly aggressive in pursuing innovative assets, and those assets are held by RTW Biotech Opportunities. Share price has got very strong momentum. It's done fantastically well this year. It still trades on a reasonable 17% discount to NAV, even though the M&A activity in the sector shows no sign of abating. Another strategy I've adopted is to look at unloved AIM companies that scope to re-rate from dual listings. One of those is happening now is Washington. So that's in the US, headquartered public policy holding company. It's a government relations public affairs and strategic communications group, but it's gearing up for a dual listing on NASDAQ. The market cap of the company is about £285 million. It offers a free cash flow yield of 7.6%, which is very high for this year, 2025, but that rises to over 9% next year, and a prospective yield next year of 2.8% dividend yield. And the price per earnings ratio, which we've talked about the S&P 500 being on a bumper 22 times earnings multiple, well, the forward PE ratio for 2026 for this company, public policy holding company, is only 12, even though analysts forecast double-digit annual pre-tax profit growth, both 2025 and 26 financial years. Another company there's a decent chance that it will actually dual list is Water Intelligence. Basically, over 90% of its business, which is water leak detection, is in the States. It's growing. It's expected to deliver decent earnings growth next year. Shares are trading on a PE ratio of 8 for 2026. Now, when you've got such lowly rated UK companies dual listing in the States, it doesn't take much in the way of earnings multiple expansion. for those share prices to re-rate quite dramatically from a P ratio of 8 to say 12 would be a 50% share price increase. A P ratio of 12 to 15 would be a 25% share price increase. So that's another strategy I've adopted to try and get around the fact that the AIM market is shrinking and is likely to continue to shrink in 2026.
I want to talk a bit more about investment trusts because in some ways they are the microcosm of what's happening to the markets in general, but in others it's a more extreme version because we have seen a lot of trust mergers starting to emerge, and certainly in recent months we've seen tender offers. We've seen, in short, the greater activity from boards in a bid to try and reduce the discounts to NAV for better, for worse in some cases. Sometimes it's been effective, sometimes it hasn't. But I think there is a catalyst there as well in the shape of Saba, the activist investor, for example, who's really got a lot of trust looking over their shoulders, a lot of trust thinking we need to be bigger or we need to do something or we won't survive. So there are opportunities for investors who are in at a discount to NAV or who've been languishing at a discount to NAV in terms of share price for a long time to potentially see that gap close up. You've spoken about a couple already, and you've said you are looking a bit more detail. Is that the kind of rationale for your thinking as well as the individual opportunities that you'd find on a case-by-case basis?
Well, I think you've got to factor in that if large investors want to get their cash out, then a tender offer is one of the few ways to actually execute that at close to net asset value. And ultimately, the shareholders, so those investors, own the economic interest in the investment companies. And if they want to pull cash out, then they have a right to do so for various reasons. And one of those reasons has been the underperformance of UK equities over the last 4 years. So since September 2021, it's been quite stark how badly UK equities have underperformed. The flip side is that it exacerbates negative fund flows. As an investment company either has to sell down assets to facilitate the capital return, or not reinvest proceeds from takeovers of the investee companies. And ultimately, not investing the capital, in many cases, weakens the investment case to actually hold for long-term gains shares in the investment company. So it's a catch-22, really, isn't it? That if you're a short-term, I wouldn't use the word speculator, but activist, and you can see potential to realize assets and narrow a share price discount to NAV, then obviously there's a huge incentive to push the board to do so, and get other shareholders on board for your cause. But ultimately, selling shares in other companies is doing nothing to actually help the rating of the UK market. And that is another reason why potentially some segments of the UK markets continue to underperform. Because if you've got the stock overhang for certain funds, then people know that there's actually a seller out there at a certain price. And I see it in the shares of certain companies that I'm looking at, and you think, why is this share price so ridiculously low? And the reason is there's a seller out there that will just strip feed shares into the market to get out. And ultimately, a massive re-rating of the UK market is only likely when you've got that overhang cleared, and not just from the investment trusts, but open-ended funds as well.
Indeed. It does seem, yes, a double-edged sword, as you say, in some ways reminiscent of, I suppose, people thinking when a company, a non-investment trust is taken over, you get a nice price boost, but then you think, well, where am I going to reinvest now? It's a slightly different type of double-edged sword in those cases because there's less of an overhang with a takeover of an individual company, but it's one of those things where the short-term and the medium-term consequences are slightly different, I think it's fair to say.
It's generally positive. The software companies have been doing relatively well, and I made a concerted effort to actually target the technology sector, and that theme has paid off quite well. Engineering companies exposed to structurally strong end markets still have robust prospects. And I'm thinking of companies like Aving that's nuclear, a very well-run company and well-respected management. Hargreaves Services is another. It's got land, energy assets, renewable energy assets. Bizarrely, I don't have much exposure to the property sector, and that was a decision made a few years ago. But Springfield Properties, that's a Scottish house builder and land developer, changed its business model earlier this year and has been selling off chunks of land and is basically looking to exploit the infrastructure boom in the Highlands. That led to downgrades because earnings downgrades because people then realized, well, actually, you're not going to be selling those houses. You're going to be leasing those houses out to various companies that need the housing for their workers to actually facilitate this infrastructure boom. But actually, investors have reacted positively. So it's a case of not all downgrades have a negative impact. So the share price of the Springfield Properties is well, it's been riding a 12-month high. Companies that have done less well are those exposed to US tariffs. Some of those took an immediate earnings hit. I'm thinking about automated packaging firm MPAC, which was a member of my 2018 bargain shares at about £1.56. Well, I mean, at one stage that share price was north of £6, and it's now back just over £3. Basically, after earnings downgrades as a result of the US tariffs and the impacts on the economy. Talking about the economy, companies. I've been keeping companies that are facing consumers off my watch list completely if they've got limited pricing power, because they're just being hit, as you said before, by a wave of cost pressure, be it national living wage, national insurance rises, and so on. But one company that actually has absorbed those and is still doing incredibly well is Ramsden's Holdings, which is a pawnbroker and diversified financial services group, and that's in a very strong earnings upgrade cycle, and that's a UK company. So, I mean, generally speaking, it is positive for the sectors that I've been following. But there is a polarization in returns, though, which I said 12 months ago, and we'll say it again, that the companies that have warned on earnings, their share prices have been absolutely smashed, whereas those in earnings upgrade cycles, investors are quite happy to play the momentum and pay the higher rating because they've got greater certainty of the upgrade cycle continuing. And I don't expect that theme to change at all going into 2026. And the one that I really, really like is the gold and silver precious metals and miners. And the reason for that, well, there's various reasons, but in terms of the silver space, these figures from UBS, the investment bank, by the way, they estimate global silver demand next year of about 1.35 billion ounces. Supply will fall almost 300 million ounces short. The market's been in deficit since 2021. And demand is only rising given the growth in the end markets that need silver. For example, electric vehicles and solar panels. An electric vehicle needs about 50 grams of silver. A solar panel, just one panel, needs between 15 and 25 grams of silver. There are other reasons why I like the precious metal space. Apart from that, you've got the stockpiles at the Shanghai Gold Exchange have now fallen to the lowest level in a decade. And gold market went into backwardization last month due to shortages for spot delivery in London, where both gold and silver in falls has been falling. Real interest rate expectations are a key driver of precious metals. Lower real interest rates reduce the opportunity cost of holding a non-yielding assets, which gold and silver are, and the market is betting that the Federal Reserve will push through a series of interest rate cuts next year. in response to the weakening job market, which they've highlighted, even if inflation proves sticky. And I think that precious metal prices could go on to further record highs in 2026. So either buying an ETF for silver or gold, or buying into the miners, silver and gold miners, which are a leveraged play on that theme, is one way to actually play it. Other sectors that I like, I do actually like REITs property. There are two that I follow, Alternative Income REIT and AEW UK REITs. Both got high occupancy rates, high yields, incredibly well run. Dividend yields of both is over 7.5%. And if I'm right, and the Bank of England decides to push through a series of cuts next year, those yields, dividend yields, are going to be increasingly attractive to investors looking to park the cash in short-term assets. And both of those companies pay quarterly dividends. That's the other thing. The other area I'm looking at is software and technology. Those sectors should benefit from likely falling short-term interest rates next year. So I'm scouring the market for under-radar plays. As noted earlier, I'm steering clear of leisure, hospitality, and retail because of the what the Chancellor's tax rises, the impacts on those sectors has been.
To speak about interest rates a bit more, is a base rate cut or a series of base rate cuts necessary? Is it going to be necessary for some companies? Because we spoke last year about debt refinancings and higher for longer interest rates. Next year will be 4 years since the first real spike in base rates. Are refinancings going to start becoming more of an issue if the base rate doesn't fall? And even if it does fall, let's face it, we're still going to be materially higher than we were certainly for the last decade. How do you feel about the need for refinancing or for raising equity, that kind of thing, those kind of pressures?
I would be very wary of certain companies with cheap finance, fixed rate finance, that expires in the next 18 months, that are over leveraged, for the simple fact that the banks will be in a ace position to either impose more stringent covenants on those companies, which may require an equity raise, so tapping the shareholders, and also be keeping a close eye on credit spreads. That's the yield differential that corporates pay above risk-free government bonds. A notable widening of spreads either signifies liquidity issues or distress. That's hardly good news when a corporate needs to refinance. The silver lining could be if the Bank of England do reduce short-term rates faster than current market expectations, and given most small cap and micro cap companies borrow either premium to SONIA or Bank of England base rates, so they're actually exposed to floating interest rates, then that could actually produce that could be more positive for more indebted companies, as they actually rise through certain challenges for the cost pressures that they're facing at the moment. But ultimately, to answer the question, I'm just very wary of companies that are high indebted, that have got debt refinancing, because it doesn't take much in terms of the debt finance markets for liquidity to actually be drained out of them. And then there's companies to be at the back of the queue when it actually comes to refinancing and pay premium refinancing rates as a result. So I'd be cautious when a company's got a very high gearing level.
We're nearing the end of our time, unfortunately, but I think it's fair to say the general tone of today's discussion has been one of cautious optimism. There's clearly challenges out there, but there's opportunities as well. So with that in mind, maybe we should conclude with our usual traditional question, looking ahead to next year's bargain shares selection, which will be out as usual at the start of February. You've spoken about some of the sectors and some of the areas that are interesting, but I wondered if there was anything more you could say at the very early stage about your thinking for that next year.
I always think that if you don't learn from your mistakes, you're just going to repeat them in the future. And a mistake I made with the 25 selection which has done well. Don't get me wrong. It's delivered about 12-13% total return. That's double the return in the FTSE All-Share AIM index, but it's lagged the FTSE All-Share index by 2 percentage points. The mistake I made on that portfolio, and ditto the one in 2024, was that I looked at several companies and I sidestepped them because I was too cautious. And for example, in the 25 portfolio, I sidestepped Vanquis Banking. That's a fallen angel from the remnants of moneylender Provident Financial. Well, the share price has doubled in value. And I could see at the time the recovery potential for it and the deep discount to net tangible assets and NAV and potential for a very low earnings multiple to actually come through if that the recovery came off. But I was just too cautious. But I did the same thing in 2024. I failed to include Funding Circle, and shares in that company also doubled. So I'm going to be more aggressive, but likely add more companies to the portfolio to diversify the risk, the concentration risk. I've got about 20 companies I'm looking at right now. But unfortunately, you'll have to wait until next year for the names of those companies.
Of course, that makes sense. Well, maybe cautious optimism isn't the right phrase then, maybe a little bit more optimism, but we shall see, of course, as ever. Simon, thank you very much for joining us today. It's been a great discussion. We do appreciate it. We have, though, come to the end of the show, so thank you again. Thank you to you for listening. Thank you to our producer, Johnny Dowling. We'll be back next time with another IC Interviews podcast.
Investors Chronicle.